Hello, very good morning to all. Welcome to today's Daily Dose of Market Insights. And today is the 31st of January 2024. So time passed pretty fast. So now we're coming towards, we are actually the end of the month of a new year, which is today will be the Wednesday, 31st of January 2024. I'm Kelvin Wong here, the Senior Market Analyst of OANDA Asia Pacific. So before we start our daily dose of market insights, let's take a look at the disclaimer slides first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exit deposit. This presentation is not offer or solicitation to buy or sell, nor financial advice for any investment product. Pardon me. This presentation, any forecast or prediction or projection in this presentation is not necessarily indicative of the future or likely performance of the product. Excuse me. This presentation has not been reviewed by the Monetary Authority of Singapore. All right. So before we start our daily dose, which is the bulk of it will be showcasing the short-term technical outlook on the broad-based asset classes, ranging from the major stock indices, the major FX pairs, gold, and as well as lastly the West Texas oil, that means WTI crude oil. Let's have a recap of what has taken shape overnight yesterday during the US session, and as well as earlier today Asia session before I speak to you guys. All right, so let's start with the US session first. So US session over here in terms of the risk on risk off behavior as exhibited by market participants is rather mixed and sideways. Why? Because we are now on the brink of a intraday risk event. That means, i.e., market participants are waiting for the FOMC outcome today. And as well, most importantly, another event which is quite important as well is the US Treasury refunding program. So later I'll touch more about that refunding program and what is it about and how does it impact the risk on risk off behavior. So yesterday in terms of stock market performance, in terms of the US stock market performance was rather a mixed bag. So that is actually pretty much kind of a, not to be on a big surprise of the things because of the risk event that is happening on the horizon today. Will be yesterday was a mixed bag. So Nasdaq 100 actually underperformed. It actually Nasdaq 100, which is i.e. the heavily weighted towards the mega cap 7 big tech company. That means the US big tech company, we call it the mega 7, inclusive of Tesla for sure. The Nasdaq 100 was actually down negative 0.6%. Then the SPX, the SPX 500 was relatively unchanged, negative 0.06%. The top performer was the Dow Jones Industrial Average, positive 0.35%. And the worst hit was the small cap Russell 2000, down negative 0.76%. So rather a mixed bag performance because liquidity driver was not the main force that is driving the risk on risk off behavior in the US stock market yesterday. Why? Because the 10-year US Treasury continued to inch downward instead. So it's more like a bit of a profit-taking scenario here and there as market awaits for the Federal Reserve forward guidance later tonight or early Singapore time later tomorrow. All right. So let me share with you the heat map of the S&P 500. Okay. Over here. Give me a minute. Yes. So this is the heat map of the S&P 500. So what we could see over here is that the one that is underperforming is for sure the technology-driven mega cap sector, where Apple is down negative 1.93%. All right. So given the fact that Apple is the second biggest market component stock, I would say second biggest market cap component stock in the Nasdaq 100 and as well as the S&P 500, almost sharing the same weight with Microsoft that just recently become the #1 market weighted cap in the S&P and the Nasdaq 100, not far behind Apple, yeah, because of the AI driven story. So now talking about the AI driven story as well. So as we know that in the last 2 weeks at the start of this year, the benchmark US stock indices, especially the Nasdaq and the S&P, has been rallying to fresh all-time high. after Dow Jones Industrial Average that made the first fresh all-time high among the benchmarks US stock indexes late last year. So the S&P and the Nasdaq play a catch-up, driven by AI-driven optimism. Especially, we start to see a lot of hope painting on corporation upgrading their hardware to be AI driven. So this morning, early Singapore time morning time, early morning, right after the close of the US stock market, which is 4 a.m. Singapore time, Microsoft and Alphabet released their earnings. So yeah, both of them topped their earnings, but market is expecting more from Microsoft due to this AI optimism. So yes, the sales estimate, top estimate, but however, healthy results were not enough to appease the market. So what do we mean by this? Because if you look at the Azure cloud services sales, which is more or less linked to kind of AI stuff, gain 30, okay, let me expand my screen so that you guys could see clearer. Okay, 1 minute. Okay, I think this resolution should be good. Maybe slightly bigger. Okay, this should be better. Okay, so what we could see over here, right? The Azure cloud services, this is a crown jewel revenue driver for Microsoft, not our Office. Our Office is not the kind of a main driver. So this cloud services, right, is more like a bit linked to AI as well, because if you want to run AI, we call it AI's enhanced office operation, you need to get a very good server via cloud. So server, data center, all this is actually part of cloud services, part under Azure, which is the another business arm of Microsoft, or in fact the crown jewel business arm of Microsoft in the last 5 years. So sales gained 30% in last quarter, compared to 29% growth in the previous quarter. So that is what actually exited the 28% growth projected by analysts. So there's only a kind of a 2%, we call it premium, or 2%, we call it 2% uh, above expectation, the difference, but market wants more, you see. And also during the guidance, right, the Azure given by the company say that growth in the Azure division will remain stable during the current quarter. I think what market is expecting is that they want to be a very stellar up move of we call it expectation in terms of revenue guidance. So that actually causes Microsoft shares to actually dip slightly during the upon the release of the earnings, but managed to recover during the close of the after hours. So after hours trading is almost unchanged. But what disappointed was actually Alphabet. So Alphabet, which is Google, the fourth quarter revenue earnings per share beat estimate. But however, the search engine right now is coming way under pressure due to AI, especially on ChatGPT. So apparently that market right now is paying very less premium to Google search engine business unit. Okay, so that the revenue actually misestimate. So all in all, right, that actually causes the Nasdaq 100 to actually tumble during the after hours trading session. That means, i.e., if you look at our Nasdaq 100, which is actually driven by our price action is being taken by the Nasdaq 100 futures, which is trading during the Asia hours as we are speaking right now. That actually went down by close to, I think, 0.4%. Okay, on a fair bit. Okay, so that is more on the US stock market performance. So what we could see over here is that there is another way to look at things over here is that right now market is now also assigning very lower probability of a first rate cut to come in March this year for the FOMC. Okay, so one of the reasons why is because the US economy continue to be in a kind of a Goldilocks scenario. So yesterday over here, there's actually the release of a conference board consumer confidence. So conference board consumer confidence actually surpassed when it came in within expectation. Markets expecting 115, it came in at 114.8, so more or less be expectation, but actually surged quite significantly above the previous December print of 108. All right, so consumer confidence in US continue to be on the uptick over here. And also there's another one called this is not really a major, they call it JOLTS, jobs opening. So it's one of the job data, not really that a major one. So the major job data will be a market that is concentrating will be the non-farm payroll data that is out on Friday. But however, we'll start to see a rosy I would say that not a really rose, a kind of stable job market in US. All right, so that job opening actually rose in December to 9.02 million job available versus 8.9 million in the previous month. In the previous month of November. So all in all, right, what we could see over here is that the US economy is still pretty much resilient in a kind of a Goldilocks-like scenario. So that actually reduces the Federal Reserve chance of cutting the first to enact the first rate cut in March. So let me share with you this. I think those who actually follow us for a couple of months already, I've been showing you guys how the market actually price expectation on Federal Reserve rate hike or rate cut, okay, before the meeting starts. So as you know that today there will be zero chance of any cut, right? Forget about the hike because we're not talking about hike anymore because the Federal Reserve has already guided us that it in particular this year we are now actually hit a rate hike plateau. That means because inflation has starts to temper off. So we are now talking about either when will be the start of the first rate cut, okay, instead of continuation of first rate continuation of that 1.5 year of rate hike. All right, so for sure today, right, there will be almost no change. That means markets are expecting the Fed to stand pat at 5.25% to 5.5%. But what's interesting is March. All right, so in March, right, earlier in the fourth quarter of last year, market has been pricing about 80% chance to 70% chance of the first rate cut to come in March. So right now, right, the odds has already starts to reduce. From a month ago, it was at 70%. All the way now, it actually reduced down to only 42%. Okay, so the market is now pricing a lower expectation of the Fed to actually start cutting in March. Below 50 now is 42% chance. So the reason I explained earlier because of resilient US economic data that very hard to justify the Fed to actually cut in March. All right, so that also kind of a reduce the liquidity infusion narrative in US. So most important over here is that we got to see how the Fed actually guide the market during the release of their monetary policy statement later today. That means that's about 2 a.m. Singapore time. Then thereafter, give me a minute, let me share with you all. So right later at this time. Yeah, so the press conference will be at 3:30 a.m. So this where also market will be paying very close attention to Powell's speech and Powell conversation remarks towards reporters' question, especially the reporters will ask him what is his view of the current US economy and also what will the Fed be looking out for to actually more or less start to think of the first rate cut to be enacted. All right. So there is still a small chance that March could be the first rate cut, but market wants to see what is the Fed is looking out for before they actually enact the first rate cut. And also on top, talking about this US scenario over here, we got to actually pay a close attention to this. Let me share with you my screen. This what I call US Treasury refunding program. Okay, so at every start of every new quarter, the US Federal, US Federal Reserve, the US Treasury, that means the government, the US Treasury will decide how much to borrow. Okay, so how do they borrow? So they will borrow either funding through long-term US Treasury notes or bonds or short-term US Treasury bills. That means lasting for 3 months to 6 months kind of bill. So they actually they released their forecast for Q1 is much lower than expected. So only is 760 billion versus earlier projection was, I think earlier was, give me a minute. Yeah, it was 55 billion below the October estimate over here. Okay, so yes, funding requirement is lower for Q1. So right now, right, on Wednesday, that means 2 a.m. Singapore time today, that means 2 a.m. Thursday Singapore time, 1 hour before the FOMC announcement, which is 3 a.m. Singapore time, the US Treasury will actually release how are they going to fund that 760 billion? Is it more, how many means this 760 billion, are they using longer term US Treasury notes and bonds, or will they continue to fund via T-bills? That means those that's very short term, 3 months to 6 months. So if they choose to fund using T-bills, they will put lesser pressure on the issuance of longer term Treasury note. So if they issue less Treasury notes over here, that means there will be market participants will instead buy bonds, not buy bills instead of Treasury notes and bonds. So that could actually continue to put downside pressure on the US 10-year Treasury. All right, so that means, i.e., as you know that after the release of this 760 billion number that is less than forecast, we realize that the 10-year Treasury yield continue to actually inch downward. Okay, going to inch downward. Okay, that was released on Monday. Okay, so you know that in the last two sessions, the price action of this 10-year Treasury start to break below 4.06%, and now breaking also below the 200-day moving average. And the daily RSI right now is actually showing medium-term downside momentum by the breakdown of that former ascending trendline support and below the 50%. So if you start to see a US 10-year Treasury that is facing downside pressure, it will actually see a weaker dollar instead. All right, you will see a weaker dollar. So if you look at the dollar in the last few sessions, it kind of trade sideways, the dollar index, and can't break above the 200-day moving average. So what it means that this bounce of the dollar since late December, end of December, that means in the last 4 weeks or so, may start to reverse and shape further downside going forward if the US 10-year Treasury will continue to inch downward on the downside scenario. So it could be a pretty much pivotal day for today as well in terms of the FX market. And if we start to see a weaker dollar coming into shape, taking into account of that 10-year US Treasury yield facing downside due to the Treasury refunding program, it could actually fit into a risk-on behavior as well. Why? Because if you look at since the start of October all the way to December, the dollar actually declined. That actually fit into a risk-on narrative for stock market, with the exception for sure of the China and Hong Kong benchmark indices, because China and Hong Kong benchmark indices are pretty much not driven by the dollar anymore. It's more or less driven by their internal structural weakness in the China economy. All right, so let me that actually touch on it right now. All right, so that actually sum up the events and the fundamental drivers that I share with you all. So now let us straight away dive down to the short-term technical outlook. All right, so the short-term technical outlook, let us start with the benchmark major indices first. Let's start with the Hong Kong 33. So the Hong Kong 33 continue to be very, very weak for today. So what we could see over here is that it came down and tested the 5,530 level, but the way it moves over here, it starts to trade a series of lower high below the 200-day moving average. Not 200-day moving, pardon me, below the 20-day moving average. Okay, so now let me expand my screen so that you guys could see. Okay, so it traded below the 20-day moving average, where price action tried to play around it in the late last week, but failed to break above it and starts to inch much lower and trade a series of lower highs. So what we could see over here at this point in time, the momentum is very, very weak on the Hong Kong 33 index over here. So like I mentioned earlier, is that yes, we may see a bit of counter trend rebound, but the trend of the Hong Kong 33 still remains on the downside from a medium-term perspective and a short-term perspective, because it's still trading below the 20-day moving average and below the 50-day moving average. No signs of a clear medium-term basing scenario that is taking shape right now. And also, if you look at today's economic data that was released earlier this morning, let me share with you, where is it? Wednesday, yeah, the MBS manufacturing PMI. So PMI data still remains to contract below the 50 level mark. So it came in at 49.2, below, within expectation of 49.2. But if you look at the trend of the MBS, the PMI data, it's hovering below the 49 level since October. Below the 50 level, pardon me, below the 50 level since October for 4 straight months. Then what we could see over here is the services, the non-manufacturing, it came above expectation of 50.6, 50.7. Okay, but it's still, where is it? Yeah, but it's still pretty much lackluster in terms of the trend. All right, so there is like no clear signs of, yeah, it's still holding above 50, but it's kind of a very lackluster kind of a growth trajectory, rather than we call it a very we call it confirm bottoming kind of formation. So it's kind of lackluster right now. So what we could see that, yes, it's still above 50, came in above expectations, slightly at 50.7, but however slightly above forecast over here. But the key thing over here is that new orders fell from 47.6 to 47.5. That's the subcomponent over here. All right, and foreign sales also fell as well. Okay, so what we could see over here is that the structural deflationary risk scenario in China is still pretty much intact by the figures that we are looking at it right now. So that actually causes the Hong Kong 33 to remain weaker from a technical perspective. So with that, we will be flipping to a short-term bearish bias on the Hong Kong 33 for today, using the 20-day moving average now acting as a resistance, which is also the former minor swing low of last Thursday and last Friday, now turns into a pullback resistance at 15,900. So as long as 15,900 didn't surpass to the upside, bearish bias for a continuation of this short-term downtrend and medium-term downtrend. A breakdown below 15,530 will retest the 15,000 psychological support level in the first step. All right, so flipping to a bearish bias below 15,900. Only an hourly close above 15,900 will negate this short-term bearish tone to see another round of counter trend rally, a minor counter trend rally to retest last Thursday swing high area, minus swing high area at 16,220. Okay, Japan 225. So Japan 225 continue to trade in an uptrend, in the short-term uptrend and the medium-term uptrend. As you could see over here is that the price action going to evolve above the 20-day and the 50-day moving average. So that is indeed a flip side of the Hong Kong 33. So what you could see over here right now is whatever misfortune in China and Hong Kong stock indices is actually a fortune for the Japan 225. All right, so I already explained in some of my longer term market outlook is that the Japan 225 now is piggybacking on internal factors that are actually positive for Japan economy, and as well as the external environment due to the ongoing trade high-tech rivalry between US and China is actually benefiting certain sector in Japan. So that actually also driving the performance of the Japanese stock market as well. So on the aggregate, the Japan 225 going to hold above the 35,350 short-term pivotal support level. So that is right now the 20-day confluence with the 20-day moving average as well. So what we could see is that yesterday the market dipped down during the US session, but managed to help on last Friday minus swing low and stage a bounce. So no change, 35,350 will be my short-term pivotal support for today. Maintain that short-term bullish outlook on the Japan 225. First resistance to watch out for will be 36,540. All right, only an hourly close below 35,350 will negate this short-term bullish tone to see the continuation of the minor corrective decline towards the next support level at 34,840. European indices using German 30 as the benchmark. Okay, so German 30 going to actually hover around the former breakout point, which is the former minus the final the range top, that I draw over here from 14th of December to 2nd of Jan now turns into a pullback support at 16,970. So with that, as you can see, it's going to trade a series of higher high, higher low, holding within this minor ascending channel support that I drew from the low of 19th of Jan. So all in all, right, no change. We will be still using I don't want to put it so tight as 16,970 as my short-term pivotal support level. So still using 16,850. So as long as any pullback manage to hold above 16,850, we will still maintain that short-term bullish outlook on the German 30 index. Next resistance to watch will be at 17,130 / 17,155, which confluence with the 2 times Fibo extension that I drew over here, and as well as a nested Fibo extension as well. This side over here. Okay, it's close to 0.764. All right, so net overall, as long as 16,850 holds, still continue to maintain that short-term bullish outlook. Only an hourly close below 16,850 will negate this bullish tone to kickstart another round of minor corrective decline within its short-term uptrend that is still intact. Why? Because it's still trading above the 20-day moving average, as well as the 50-day moving average. Okay, so the next support level to watch if we start to break below 16,850 will be that the 20-day moving average over here, 16,710, then slash 16,620. All right, RSI still remains positive above the 40% parallel support, 40 parallel support level. US indices, the Dow Jones is still outperform, clear above our first resistance in our expectation at 38,400. So with that, we'll be using a much tighter short-term pivotal support for today, 38,200. What is 38,200? Minor swing high area, or former minor swing high area of last Friday, also the minor ascending channel support that I drew from the low of 18th of Jan, also conferencing at 38,200. So 38,200 support level, potentially there could be a bit of pullback taking into shape, given that today the risk event that I highlighted for today early on, Treasury refunding program announcement, as well as the Federal Reserve FOMC. So, but hourly RSI, yes, it's overbought, so there could be a bit of pullback. But the way it goes overbought, there's no bearish divergence. That means price RSI shape higher high in line with the price action higher high as well. So any pullback, yes, it may happen, but as long as this pullback managed to hold above 38,200 level, we will still maintain that short-term bullish outlook on the Nasdaq, on the US Wall Street 30, pardon me, which is the Dow Jones Industrial Average. First resistance to watch will be at 38,750. Next resistance to watch will be at 38,750. An hourly close below 38,200 will invalidate this bullish tone to kickstart another round of minor corrective decline within its short-term uptrend. Why uptrend? Why uptrend? Because price action going to trade above the 20-day moving average. Next support level for sure will be the 20-day moving average, now acting as a support at 37,800. We also confluence with the previous minor range resistance that was formed from 29th of December to 12th of Jan, broken out middle of this month, now turns into a pullback support at 37,800. So net using a tightened key short-term pivotal support for today at 38,200 for any potential pullback to maintain this bullish outlook, short-term bullish outlook on the US Wall Street 30. Lastly, Nasdaq 100. So Nasdaq 100, yes, this is what you see this morning over here during the Asia session, where it at this point in time, where it plunges to 0.9%, 0.9%, okay, after the release of Alphabet and Microsoft earnings. So it's now playing with our 17,330 short-term pivotal support. RSI already dipped down to the oversold level. So with that, right, for sure, this is indeed a support level to watch, because at the moment, the price action, the selling try to stop right exactly at this support here. So what we could do over here is that 17,033 short-term pivotal support, maintain that short-term bullish outlook. So I'll be having this upside trigger level over here. Okay, so this is where the start of that intraday sell-off took shape. So now this will be a pullback, kind of a previous support turns into a pullback resistance. So upside trigger level 17,520. So hourly close above 17,520 increase the odds for the next resistance to come in at 17,750. Okay, so no change. Still using 17,330 as my short-term pivotal support to maintain that short-term bullish outlook on the Nasdaq 100. So what's new today is I added in a potential upside trigger level at 17,520 over here. So an hourly close above 17,520 kind of increase the odds for the price to actually see a continuation of this impulsive up move. Next resistance to watch will be at 17,750. Only an hourly close below 17,330 will negate the bullish tone to kickstart another round of minor corrective decline within its medium short-term uptrend. Why short-term uptrend? Because price action is still trading above the 20-day moving average towards the next support zone at 17,060/16,910. Okay, so that's pretty much sum up for the major stock indices. So all the major stock indices, we are still maintaining that short-term bullish outlook. The only difference for today is we flip to a bearish bias on the Hong Kong 33 index because of a weak technical element, and also we added an upside trigger level on the Nasdaq 100 at 17,520. Okay, now FX market. Let us start with the European currency. So on the European currency over here is that the sterling dollar, yes, yesterday it came down, tested the lower limit of the neutrality range, 2640, and it start to bounce. So no change. The sterling dollar going to trade within this symmetrical triangle range configuration since the high of 28th of December. Okay, so we will be maintaining that sideways range outlook on neutrality range outlook for now at 12760, 12640, the lower limit. All right, so then at this point in time, we will have the euro dollar. So euro dollar, we also flip to a neutrality range bias as well due to its conflicting elements at this point in time. So the euro dollar going to be on the upside, it's going to be suppressed by this minor descending trend line resistance that I draw from the 11th of Jan, trading below the 20 and the 50-day moving average, much weaker than the sterling dollar. If you look at the sterling dollar, managed to still hover around the 50-day moving average. You still manage to trade above the 50-day moving average, but the euro dollar starts to trade below the 50-day moving average. So it's kind of a more weaker momentum than the sterling dollar. All right. So with that, right, what we could see over here is that the euro dollar, we will still maintain that short-term neutrality range bias that we have so far between 1.907, which confluence with the 20 and the 50-day moving average acting as a resistance as well. Monday minor swing low will be at the low, will be our lower neutrality range at 1.0795. So still maintain that neutrality outlook between 1.0907 and 1.0795. Now Aussie dollar. So Aussie dollar today, this more pardon me, got sore throat. It managed to actually trade much lower, playing around the 200-day moving average, but where it's actually stopped, it managed to stop at the 65.60 level, former minor swing low of 24th of Jan, and also now the pullback support of this minor descending trend line resistance formerly was from the high of 28th of December, taken out earlier on this Monday, over here, and right now turns into a pullback support level. All right, so all in all, what we could see over here is that yes, this morning sell off of the Aussie dollar was actually driven by the fact of this weaker than expected CPI Q4 data out from Aussie land. So what you could see over here is that the RBA trim mean, so it remove off the outlier, the year on year, so it's a Q4 thing. So the Q4 CPI year on year in Aussie land came in slightly below expectation. Market is expecting at 4.3% year on year, but it dipped down to slightly 4.2% year on year. So given a weaker or a softer inflationary environment in Aussie land or in Australia, that will actually reduce the hawkish tone of RBA. So that actually causes the Australian dollar to actually sell off, but it actually sell off right back to the support level again. So no change, right? It's more like a bullish bias within a range configuration. So still using 65.60 as my short-term pivotal support level. Range stop will be at 66.20. All right, so 6020 also confluence with the 20-day moving average as well right now. So still maintain that short-term bullish outlook on the Australia dollar. Only hourly close below 65.60 will start to see another dip down to retest last week's swing low, which is also the medium-term pivotal support level at 65.20. Why medium-term pivotal support? So if you look at the daily chart over here, 65.20 confluence with this previous significant medium-term congestion area over here now turns into a pullback support 65.20. All right. Lastly, dollar yen. Okay, so dollar yen continued to churn sideways as well yesterday after the sell-off that took shape earlier on Monday. So, but still remains below the 49.80 short-term pivotal resistance. So no change, 49.80 short-term pivotal resistance. So as long as this level is not surpassed to the upside, potentially the dollar yen will maintain that short-term bearish bias. Next support level to watch 46.25. All right, 46.25 level. Only hourly close above 49.80 will invalidate this short-term bearish bias to see a squeeze up towards the next resistance level at 150.20/70. Now, what next will be gold, spot gold. So spot gold over here going to trade in a series of higher high and higher low. So I could see over here price action now trade higher high, then higher low, surpassing above the 20 and the 50-day moving average over here. All right. So right now, what I could do over here is that let me push this up. Okay. So I do not want to use the 20-day and the 50-day moving average, means yesterday's swing low here as my pivotal support because it's too tight. 2029. So I was still using 2015 as my short-term pivotal support level. So 2015 short-term pivotal support maintain that bullish outlook in any pullback, short-term bullish outlook and pullback. Intermediate near-term resistance to watch will be yesterday high at 2048 level. So above 2048 level, potentially sees another resistance to come in at 2060, which is, I would say, is a more of a medium-term range resistance that is in place since minor range resistance, pardon, in place since 5th of Jan. Okay, that was tested on the 12th of Jan as well, didn't surpass, and that did that sell offer, and now it's the attempt to do that recovery by shaping a series of higher high, higher low, and yesterday price actually managed to trade above the 20 and the 50-day moving average retest, but managed to so far hold above this level at 2029. But don't be so tight. 2015 short-term pivotal support maintain that bullish outlook. Only an hourly close below 2015 negate this bullish tone to see another round of choppy decline to retest the medium-term pivotal support at 2000 level. WTI crude oil. So WTI crude oil continues to actually be a bit of sideways movement. So right now, yesterday it came down, hit the first support level, 75/30 level, and now it's shaped another bounce back again now. So right now it's also intended to actually play around the 200-day moving average. So no change using 78.40 short-term pivotal resistance level. Looking for another potential dip down towards 75.30. Below 75.30 may see a further push down towards 73.90, which is also confluence with the 50-day and the 20-day moving average. So what we are doing right now over here is more like looking for a bearish corrective retracement to retrace this last 1.5 week of rally that started from 3rd of January. So if you look at the Fibo retracement taking from 17th of Jan all the way up to this Monday's swing high, 38% and 61.8%. All right. So no change, still maintain that short-term bearish outlook on the West Texas oil as long as 78.40 short-term pivotal resistance holds. Only an hourly close above 78.40 will invalidate this bearish reaction bias scenario. That means we're talking about for a short-term bearish reaction within a potentially short-term uptrend that is taking shape on West Texas oil. Okay, then above an hourly close above 78.40, we'll see the continuation of this bullish impulsive up move. We're in is involving short-term uptrend that is taking shape right now towards the next resistance at 79.75. Above 79.75 sees the next resistance coming in at 81.80/82.50. So what's 82.50? If you look at it over here, is in fact this congestion zone over here, and for also the 50% retracement of the previous medium-term decline from 28th of September to 13th of December over here, which is the 50% people retracement at 81.80, 82.50. All right, so with that, I'll sum up today's short-term technical outlook on the major US stock indices. The major FX pairs, gold, XAU/USD, as well West Texas crude oil. So I already covered the key event to look out for today will be the US Federal Reserve FOMC meeting. So keep a lookout for the tone in the monetary policy statement that got to be released at 3 a.m. Singapore time, and thereafter 3:30 a.m. Singapore time will be the Federal Reserve Governor Powell press conference. So that will actually give us an indication of a forward-looking monetary policy guidance that he wants to portray to the market participants at this point in time. So with that, today will be slightly more longer because more things to cover. So with that, have a great day ahead, and we shall speak again tomorrow. Thank you.